in Chapter 6, Capital Investment Appraisal. Within Chapter 6, we are discussing capital budgeting technique. Lastly, we discuss accounting rate of return, payback period, discounted payback period. Now we are going to discuss net present value. So after this analyzing or discuss, we will understand net present value, advantage and disadvantage of NPV, formula of NPV, use of NPV, calculation of NPV. What is present value? The net present value takes into account the profitability of analyzing cash flow over the life of the project. That means whole life cash flow is considering here. It used the cost of capital to discount the cash flow. Net present value is the difference between the present value of cash inflow and the present value of cash outflow over a period of time. And we also know it is the difference between the present value of cash inflow and outflow. So here we can say that NPV stands for net present value. It is used to determine the present value of all future cash flow and considering the time value of money. Net present value method is a process of calculating the present value of cash flow, inflow and outflow of an investment proposal using the cost of capital as the appropriate discount rate, and finding out the net present value by subtracting the present value of cash outflow from the present value of cash inflow. So we can generally we can say this way we can calculate NPV and all cash flow. This when if long series, then we can calculate this way. And also there is short formula also. So this is the basic thing is that. So here NPV equal to summation of that means a benefit minus cost and 2 to the power t, that means year, divided by 1 plus r. R means discount rate, 2 to the power t, t means year. So this is the basic formula. Also it is the we can calculate also this way, and different types of formula which is the based on the given data. So NPV equal to net cash flow, initial cash outflow of the project, and this one is initial cash outflow of the project minus and net cash flow. It is the net cash flow generated by the project at a time of t time, and 1 plus k means required rate of return, and 2 to the power t means here that year time, and so in how many year it may be. Also NPV is calculated by discounting the future cash flow, we know. So here also this also can calculate different types of easily. So net present value of investment equal to net present cash flow plus present value of cash sheet minus initial cost of investment plus service value. So key point is that the present value or NPV is used to calculate today's value of future stream of present value. That means how much money we'll get in future, year after year, that bringing it to today's value. So it is the used to calculate today's value of future stream of payment or cash flow. And if the NPV of the project or investment is positive, it means that the discounted present value of all future cash flow related to the project or invested will be positive and therefore attractive, have to take the project. And to calculate NPV, we have to estimate future cash flow for each period and determine the correct discount rate, which rate we should use. Basically we are using the cost of capital is the discounting rate we are using. So it is the formula different types. So here is for example, look here, initial cost 6,000, life of the asset 6 years, annual cash inflow 2,200, service value 0, required rate of 20. So what would be the annual cash inflow? Year 1 to 6 years. It is the every year 2,200, and it is the 20 factor. We have to go to the PV factor sheet also we can calculate it for the calculator also. So here summation of from year 1 to 6 NPV discount factor summation is 3.326. and with multiply with the 2200, then we will get 7317. And initial investment we already invested 6,000, so net present value would be 1317. So this way NPV can calculate it. So here basic thing is that if we see here, in the year 0 invest 1,000, it is the outflow. In the year 1, 400 or 400 million will get is the positive, that means cash inflow. Second year 600 cash inflow. Third year 200 cash inflow. And the discount factor, cost of capital is 10%. So 10% PB factor in the year 1 factor is 0.9019. And the year 2, 0.8264, and the year 3, 0.7513. So if we multiply this 4,000 with this factor, then we will get 363.64. Same way, 200 multiplied by 0.7513, then we will get 150.26. If we add it, because here only 3 positive, 1 negative. So here positive outflow, positive result is come 9.77. It's been positive in PB. It's been that our required rate or discount rate is 10%. So it is the more than 10% is within here. So that's why this project can be taken, because NPV is positive. It is the decision criteria of NPV. So here also another one in the same way what we discussed is above. So it has some advantages of NPV. What is that? It recognizes the time value of money. It's the fundamental and right thing. It's recognize the time value of money. It consider all cash flow. It's consider all cash flow over the entire life of the project in the calculation. It is consistent with the objective of maximizing the welfare of the owners or the organizations. If positive, more positive, it taking that project. It is difficult to use. It is not easy to as accounting rate of return or payback period or discounting payback period. It is sometimes difficult, and it is pursues that discount rate, which is usually is the firm cost of capital is known, but is practical. Understand that cost of capital is equal to the difficult concept. So which factor we should taken for the discounting factor? It is the cost of capital or other thing. So it is the question that that rate is accurate or not. It may not be given satisfactory answer when the project being compared involve different amount of investment. So for example, when investing 100 million, another investment 1 million. So but the 101 is not the same. So that is the satisfactory result cannot become here sometimes. Here is a math, net present value, simple math. A company needs a machine for manufacturing process. The cost of new machine is 80,700. The expected useful life of the machine 8 years. And after 8 year end, the machine will have no salvage value, but the salvage value is 0. After installation, the machine would increase the cash inflow by 30,000 per year. Interested to know the NPV of the machine to accept or reject the investment. The minimum required rate of return 16% of all capital investment. So it is the data from this math, and they compute the net present value of the machine. It is acceptable to purchase the machine is the question. So answer is here, net present value. So here year 1 to 8 years, annual cash inflow for every year 30,000 as given in the question, and 16% factor for the 8 years taken from value from the present value of annuity of $1 in arrange from the table is come 4.344. So with 3,000 multiplied by 4.344, then we'll get 1,30,320. And from that amount, if we deduct the initial investment of the machine, then we'll get net present value 49,620. So what would be the answer? So decision would be that purchase decision. The positive net present value indicate that the investment is profitable. Therefore, the machine would be purchased. The very simple is the single one. When alternative, that means project 1, A and B, that time of comes sometimes. A company considers two projects, project A and project B. Project A requires the purchase of equipment, not working capital. Project A requires is a cost of equipment. But project B requires the working capital, not the machine. Same figure. Annual cash inflow 1,660,000 for project A and 1,020 for project B. Salvage value, that is a scrap value of the equipment, 40,000. And here project B, no machine, that means no scrap value. Project life is 8, both. The working capital required for the project B would be released at the end of the project life. So this working capital 6 lakh, the release in the year 8. This company used the 18% discount rate. Are the two projects comparable? Use the net present value? If yes, select the best investment using the net present value method. NPV of project A and another calculation NPV of project B. So after calculating, then we will say this answer, yes or no. First have to calculate this one. So project A, cost of equipment 6 lakh is the minus in the year 0 year. Annual cash inflow 1 to 8 years. Every year get 1,60,000 for the 8 years. So here taking again from the sheet, annuity of 8 years, 18% factor 4.078. So multiply with this 1,60,000, we'll get 6,52,480. Again, salvage value, this amount will come in the years 8. So this amount, that is 40,000. The 18% factor, PV factor of year 8 is 0.266. So 0.266, if we multiply 40,000, then we'll get 10,640. So this one, and also add here 6,52,480, and also minus 6 lakh, then we'll get 63,120 is the net present value of project A. And now have to see the project B. As said, is use the working capital 6 lakh. Also release that 6 lakh in the year 8, 6 lakh. But the value of the 6 lakh, now it would be 1,59,000, because using this 0.266 PV factor, multiply this 6 lakh, we will get 1,59,600. And annual cash inflow, it's the 1,20,000. If we multiply the annuity factor 18% or 8 years, then we will get 4,89,360. So adding three things, we will get net present value of machine B is 48,960. So look here, it is the more than that. So according to NPV method, project A took more desirable because it needs present value is more than project B. So project A should be accepted. So this is the difference way here calculating. Same way here, another one, compare and just do it, sir. And here a math, NPV and payback period both are here, NPV and payback. Also here net present value of new project. Another one is simply NPV calculation. a good one, a nice one. Here plan A and B. Interest rate is that, and present value is here. Here calculating is the working cost per unit calculation, and then decision. See is the solution here. Also within the capital budgeting, here another as a marks 10 marks probably. So here 3 project, and is the capital that one the calculating that. Here 5 item have to solve. Calculate the payback period of each 3 project. The cut-off period of 2 years. Then which project would be accepted. So different ways calculating here. Here a question here. A manufacturing unit of a company engaged in the production of automobile parts of considering a proposal purchasing one of 2 plants, plant A and B. One of 2 plants. One will be purchased. So the annual cost of 2 plants in the first line, running hour per annum, 2,500 hours. Also plan B same. Cost, wages, indirect material, repair, power and fixed cost in just separate single way. And details of the plan A and B are given below. The cost of plan A is 20 lakh, B 38 lakh, installation charge 4 lakh, B 2 lakh, life 20 years is 15 years, scrap value after full life 4 lakh and 4 lakh, output per minutes 200 units, here 400 units, interest on capital 10%, and 10% table is saying here. For the 20 years, present value of 1 is 0.1486 and 15 years 0.239. Annuity, this one. So this is the question. Will be the advantage to buy plant A or B? Sub-essential your answer, and here the comparable unit of plant. Make your relevant assumption. So first have to calculate the equivalent annual cost. That means it's the one of working. Look here. Cash outflow 40 lakh for the machine, 24 lakh and 40 lakh. Less present value of salvage value. Look here. 4 lakh salvage value multiplied with the PV factor. Here come for the machine A and this one for the machine B. And annuity factor is 0.1175 and 1315. So here what we do, 24 lakh plus 59,440 multiply by 0.1175. Then we will get 275,0160. Same way 513,408. So compute a cost per unit. So here annual output 2,500. Here said here output per minute 200. Here 400. So this 200 per minute and 60 minute per hour. That means is turned into annual. In the year is output is 3 crore. So have to calculate in that means 200 unit per minute. So per minute 200. Then whole year unit is 3 crore unit production. Same way machine B 6 crore because it's the double. Here 400 is a double. Now wages 1 lakh, but that means that figure here come. This wages is the annual. Here said that is annual cost. So this annual cost putting there. All are annual cost. So fixed cost, equivalent annual cost, this come from here. This one is a no problem. The equivalent annual cost is there 2,75,016. Here 5,13,408. It is putting here 2,75,16, 5 lakh. So here total cost is that, and cost per unit, that means here 12,35,016 divided by number of unit 3 crore. Then cost per unit is 0.041. Same way 17,13,408 is the cost, annual cost for the production from the machine B, and divide from the number of production unit 6 crore. Then cost per unit is 0.02860. So what would be the answer? Which is the more and less? As the unit cost of less is the proposed plan B. Look here. Here per unit cost 0.04, but here unit cost 0.02 or 3. It may be recommended that it is advantage to acquire plan B. So it is the, as an company secretary, you suggest your company to take the plan B, because here cost per unit is less than machine or project A. So it's one here. So that type of math may come in different way, but definitely you will get the math from this chapter. Compare a project using NPV method. A company trying to choose the best investment project from two alternative projects. The company has 30,000 to invest. That means it have only 30,000 to invest. It can invest only one. The information about two alternatives is given below here. Investment required 30,000. The both project X and Y. Annual cash inflow here 8,000 for the project X, but not inflow project B. And single cash inflow at the end of the 8 year for the project Y. That only after 8 years you will get 1,20,000. But project A, annual cash inflow every year $8,000 will come. That means get inflow for the 8 years. That means every year that project will give $8,000. Life is 8 year both. The discount rate 15%. Give your recommendation to the company in selecting the best project to invest 30,000. Though the company have only $30,000 have for investment, so have to choose which project should accept, X or Y. Come here, as like previous one, net present value of X. So inflow 8,000, 15% factor is the 4.487. Multiply with this 8,000, we will get 35,896, and from that investment required 30,000, then present value would be 5,896. And now come net present value project Y. Here same way 8 years. That means this 1,20,000. Only one cash flow in the year 8 come. So 15% PV factor will get in the 8 years PV factor at the rate of 15%, 0.327. If we multiply 327 with the 1,20,000, then present value of cash inflow 39,240. So investment requirement that was 30,000. So net present value was 9,240. What would be the recommendation? Project Y net present value is more than project X. That means 9,240. which is more than project X net present value. Project Y is therefore more desirable. So you recommended for project Y. So this one. So this way that type of simple math may come. Okay, sir.